So far, we've spent this week with profitable companies, book income, taxable income, everything positive. In this last lesson, we consider what happens when the year goes badly. When taxable income is negative, we have a net operating loss. And it turns out that a loss this year is actually worth real money in future years. Our job is to account for that value and to be honest about whether we'll ever collect it. Think about two companies over 2 years. Company A earns $100,000 each year. Company B loses $100,000, then earns $200,000. Same total income, $200,000. If the tax system looked at each year in isolation, Company A would pay tax on $100,000 twice, while Company B would pay nothing in the first year and then be taxed on the full $200,000 in year two. More total tax on identical total income purely because B's income was lumpy. The tax code fixes this by letting losses travel through time. That's the net operating loss deduction. A net operating loss is simply negative taxable income. Tax deductions exceed taxable revenues for the year. Under current law, the rules are clean. NOLs carry forward for losses arising in recent years, and there's no carry back. And they carry forward indefinitely. No expiration clock. The one catch is a usage limit in any future year. The NOL deduction can offset at most 80% of that year's taxable income. So a big enough carry forward shrinks a future tax bill dramatically, but it can never zero it out completely. The IRS always keeps a toe in the water. You may say older materials that mention 2-year carrybacks and 20-year limits, but that's the old regime, and for our purposes now, it's history. Now the accounting question. Is a carry forward worth anything today? Absolutely. It's a stack of future tax deductions, and future deductions are exactly what a deferred tax asset is. Sound familiar? Because it should. An NOL carryforward is a future deductible amount, the same species as the warranty accruals and unearned revenue from earlier this week, just bigger and born from a loss instead of a single transaction. So in the lost year, debit a deferred tax asset for the NOL times the enacted future tax rate, and then credit income tax expense. Though with a loss, that credit is really an income tax benefit. It flows through the income statement and shrinks the reported net loss. A $310,000 loss at 25% produces a $77,500 DTA and benefit. So the after-tax loss is only $232,500. The loss year gets to keep some of the silver lining. Now fast forward to when the company turns profitable and it's time to spend the carry forward. Say income before the NOL deduction is $100,000. The 80% limit caps the deduction at $80,000. So taxable income is $20,000. And the check to the IRS is small. But notice what the entry looks like. Tax expense is still full freight. Income times the rate. Because using up the DTA isn't free, we debit tax expense $25,000. Credit the DTA $20,000 as we consume the benefit that we recorded back in the loss year, and then credit tax payable $5,000. Whatever NOL is left keeps carrying forward indefinitely until income absorbs it. One more piece, and it's the honest broker piece. A DTA is only worth something if there will be future taxable income to deduct it against. A company that just posted big losses may not inspire confidence on that front. So GAAP's test is if it's more likely than not, more than 50%, that some portion of the DTA will not be realized, we must record a valuation allowance, a contra asset that writes the DTA down to what we genuinely expect to use. So debit income tax expense, credit valuation allowance. And it's reassessed every year. If prospects brighten, we release the allowance. Debit the allowance, credit tax expense. And that release can produce a surprisingly low effective tax rate in a recovery year. Watch for the judgment here, by the way. The allowance is one of the most discretion-heavy estimates in the financial statements, and auditors watch it closely. Let's work through an exercise with two different companies. Crabtree has an NOL in 1 year and then they use it in the next, whereas Walnut has 2 years of losses, doubts that it will be able to use the NOL valuation, and then offsets it with an allowance, recovers it, and then applies the future deduction. Okay, we're going to start with Crabtree, who in year 5 had a $310,000 NOL. So NOL is the net operating loss. It's the amount that they're going to be allowed to offset their future income, but the tax effect of that is times 25%. So $77,500, which gives us a journal entry where we debit a DTA for $77,500, and we actually credit income tax expense, which normally we debit an expense account. Right now we are crediting it, so it has the effect of a income tax benefit rather than an expense. It's a positive number in retained earnings. So that's year 5. Then in year 6, Crabtree can use this NOL. So they can take the income that they earned this year of $100,000, for which they would normally pay 25% tax. and they would pay $25,000 tax expense. And they can actually offset some of that income and pay the IRS less than that. So the offset rule is that they can take their entire NOL and offset their income, or the lesser of that NOL, or 80% of income. So we actually are limited here. Crabtree is limited by the 80% rule. So they can take 80,000, which is 80% of 100,000. That's what their limitation is. And that's the NOL offset, but the tax impact is multiplied by 25%. So the tax impact here is $20,000. And that's how much of our DTA we're going to use. And their taxable income then is $20,000. And their taxes payable, what they actually have to pay the IRS, is only $5,000. So they're going to recognize tax expense for the full amount of what they would have normally had to pay the IRS. But because they get to use some of that DTA, and that is $20,000, they only actually have to cut a check to the IRS, taxes payable, of $5,000. Okay, now we're going to work through Walnut Corporation, which they've got two losses here in year 1 and 2, 300 and 100. So we're going to multiply that by the tax rate in each of those years and book our journal entry to record a DTA in the amount of $75,000 for the first year and $25,000 in the second year. So the total NOL that they have to apply to future years is $400,000. So again, in year 1, we're going to debit DTA and credit tax expense for 75, and we'll do the same thing in year 2 to record the DTA and the credit to tax expense for 25,000. Now, at the end of year 2, they've also told us that they decided that part of their NOL is unrealizable, which means we need to take the amount that they don't think that they're going to be able to realize and multiply it by the tax rate and reverse out that tax expense benefit that we recorded. So the debit to tax expense here is 25% of 160, which is $40,000. All right, so that's 40,000. And we will credit an NOL Valuation Allowance for $40,000. So we'll do that in year 2. Now it's year 3, and they actually have some income. It's $100,000. So in year 3, I can take the lesser of my entire NOL, which is $400,000 or 80% of income. So I know that I've got an $80,000 deduction. I'm limited by that 80% floor, so 80,000. And so if I take the income of 100, right? So book income was 100,000. Then that means I'll have taxable income of 20,000. And so I can build my entry exactly how I did for Crabtree, which is to debit tax expense for 25% of the book income. I'll credit my DTA for the amount that I get to use, which is 25% of the deduction. So that's 20,000. And I'll credit taxes payable for what I actually have to pay the IRS, which is 5,000. Now, I've also decided at the end of year 3 that I am going to fully realize this 160, so I don't need to have that entry anymore. I can back that out. So I'll debit my valuation allowance here and credit income tax expense in the amount of 40,000. So I'll wipe that out and it's no longer needed. Now, finally, it is year 4, and we've got $300,000, and we just keep draining that carry forward. So it would be helpful at this point to calculate what our remaining NOL was or is. And so in year 4, we have a remaining NOL. We had 400,000. We've used up 80,000. So we've got 320,000 left to use. And again, this is the net operating loss, not the tax effect of it. So the deduction we're allowed to take in this year, though, is limited by 80% of our book income. And we have $300,000 this year. So 80% of that is 240. So we have to choose the lower of these. So this is our NOL deduction in year 4. So we can take that book income of 300. We can deduct the 240, and that will give us taxable income of $60,000. So our taxes payable is 25% of that at $15,000, and our tax expense is calculated as 25% of the book income, so $75,000, and we can use up some of that NOL, $240,000 to be exact. And we've already used 80. Now we've used 240. So there's a little left still. And that is in the amount of $60,000. So that would be a DTA. So we'll debit tax expense for $75,000. We will, credit the DTA for $60,000, and we'll credit our taxes payable for $15,000. So now the remaining NOL at the end of year 4, it started as 400, we used 80, and now we've used 240. So we've got 80,000 to go to offset income. So that's the amount we can offset income. The remaining DTA, though, is only 25% of that. So 20,000 is the remaining DTA. To wrap up, a net operating loss is negative taxable income, and under current law, it carries forward indefinitely, no carryback, with the deduction in any future year capped at 80% of that year's income. In the loss year, the carry forward becomes a deferred tax asset and an income tax benefit that softens the reported loss. In profitable years, tax expense runs at full rate while the DTA drains away, and the cash payment stays small. And when realization is in doubt, more likely than not that some benefit will be lost, the valuation allowance writes the asset down honestly and gets reassessed every year.